I'm a big believer in gold, as you know, and in silver and in platinum. And I think that at some point here, we may need gold, silver, platinum, and crypto as a currency because of the weakness of the fiat currency system around the globe, because that is nothing more than a fraud Ponzi scheme anyways, because the currencies are really worth nothing and they're actually just loans. And that's really the problem, that the central banks around the globe have too much power to reduce or manipulate or crush these currencies. And you see them, it's a race to the bottom with these high numbers of inflation.
Todd "Bubba" Horwitz, a seasoned market veteran with over 40 years of experience in trading and investing, strongly advocates for the value of gold, silver, platinum, and cryptocurrency. He argues that the global fiat currency system is inherently flawed and unsustainable, and that these tangible assets may become essential as actual currencies someday. Since the U.S. abandoned the gold standard in 1971, the dollar's value has significantly declined, leading to a substantial loss of purchasing power. This depreciation undermines confidence in the dollar as a stable store of value domestically and internationally. The fluctuating value of the dollar adds a layer of uncertainty to global trade and investment, complicating economic relationships and fostering instability. Frequent asset bubbles and financial crises have further eroded the stability of financial markets. For instance, the dot-com bubble of the late 1990s and the housing bubble of the mid-2000s were exacerbated by Federal Reserve policies of low interest rates and easy credit, which fueled speculative excesses. Horwitz emphasizes that fiat currencies, which he views as essential loans, are susceptible to manipulation by central banks, leading to inflation and a general devaluation over time. While the Federal Reserve and the fiat currency system have played critical roles in modernizing the U.S. economy and providing flexible monetary policy tools, they have also faced significant challenges and criticisms. Recurring issues such as inflation, economic instability, financial crises, slow long-term growth, and transparency concerns highlight the shortcomings of these systems in achieving their intended objectives. Please tune in for our exploration of Horwitz's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
If you compare the moves in gold and crypto, they're pretty similar over recent history. And I think they're both good products. Listen, I'm a big believer in gold, as you know, and in silver and in platinum. And I think that at some point here, we may need gold, silver, platinum, and crypto as a currency because of the weakness of the fiat currency system around the globe, because that is nothing more than a fraud Ponzi scheme anyways, because the currencies are really worth nothing and they're actually just loans. And that's really the problem, that the central banks around the globe have too much power to reduce or manipulate or crush these currencies. And you see them, it's a race to the bottom with these high numbers of inflation. Gold is a good start. I mean, obviously there's using derivatives to hedge and use that against your portfolio, which I do use. There's ways to do things using the products correctly without putting yourself in jeopardy and actually knowing exactly what your overall exposure is to any market. But certainly I believe that everybody should have at least 5 to 10% of their total net worth in gold or in silver or in some sort of metal, because I think that they're not going anywhere. And I do believe, once again, that they could be needed as a currency at some point in the coming years. Listen, I'm still saying, I've said this for over years, so again, this isn't new, but I still think there's a 50 to 60% haircut coming to the markets. I don't think it'll be tomorrow. I don't think it'll be this year, because again, elections are very tricky. But again, I think the banks are in trouble. I think we have a lot of problems that are out there. But I think the one thing you have to remember, if you're an investor in the stock market has gone up 8.5% year over year since the inception, and 10% year over year since 1950. And every time you see that big sell up, that big panic, or as we used to call it on the trading floor, the big puke, you buy good companies, they're going to rebound. And of course, I told all of my people on Monday that you should be looking for a spot to buy good, solid companies, because they're probably going to rebound, which is the same thing I saw in 1987 when we had that big meltdown. And I think that if this country is going to survive, and we're going to see a system that's going to work, then the stock market is not going to stop its 8.5% year over year gains. Now we may be down next year, we may be down the year after, but if you're using money that is not over leveraged, that you're going to have to sell out, then you should be accumulating assets that are going to grow, gold, equities, and continue to buy into weakness.
Todd Horwitz notes that the recent market rally occurred without the expected interest rate cuts and warns that implementing cuts now could do more harm than good by signaling panic. This concern ties into a broader issue: the erosion of capitalism. The shift toward a standard 25 basis point cut reflects a return to normal market sentiment. Earlier this month, intense market gains were erased, bond yields returned to their pre-jobs report levels, and the flight to safety slowed. The Federal Reserve's most recent rate-setting meeting concluded on July 31st, just days before the U.S. reported an unexpected rise in the unemployment rate to 4.3%, the highest in nearly 3 years, up from July 20th, 23's 3.5%. This uptick triggered a recession indicator that has historically preceded major economic downturns. These factors suggest underlying economic instability, further supporting Horwitz's concerns about the potential damage of poorly timed rate cuts and capitalism's broader challenges. Let's get back to the interview.
So we got the big rally, and of course we never got the cuts. So now if you get a rate cut, it's going to be more damaging, because now a rate cut would not be positive. A rate cut would be negative, because it would be panic, especially if they would have cut last week under an emergency. But what we're really seeing is the true destruction of capitalism, because when you don't allow businesses to go out of business because they don't perform well, and you continue to bail them out, hence the banks going back to '08, this is a problem, and this is a destruction of capitalism. And this is what we're seeing globally, is they want globalization. They basically want the middle class to become serfs again, like they were thousands of years ago. And they want to have the bourgeoisie up at the top to have all the money. And that's really what you're watching. You're watching a destruction of capitalism, and you're seeing that this is happening all the time. And at the end of the day, if we don't get back to a free market capitalism system, because interest rates should not be determined by the Federal Reserve. Interest rates should be decided by the free market, because asset classes know how to price themselves. It's very simple. There's a buyer and there's a seller, and they will find the correct rate. And certainly the rate, even at the low rates we are now, or high for many, if you're under 40, these are very high rates. Okay. But if you're my age, these rates are still very, very inexpensive. And of course, if you look at some of the peer-to-peer lenders, they're getting 15, 16%. And if you're looking at the credit cards, which are using usury rates, which are in the mid-20s, those rates, that we have more people at the max on their credit card that can't make anything but the minimum payment, which means they're never going to pay it off. So tell me we're not in a recession. Make up all these lies about how the economy is doing, because in my opinion, and I think if you ask the average American, the economy is in horrific shape. If you go back to 1988, an average home was $150,000. That same home today is $720,000. So you look at the expands in the indexes from that day, you'll see that they're in proportion to those, if not a little bit higher. But at the end of the day, you have to make more to be able to live less than you lived then, because everything is so much more expensive, and they refuse to admit that inflation is higher. We're not at 3.5% inflation. That is a joke. We are way north of 10%. Just look at crude oil or gasoline. You're paying, depending on where you live, but let's just say the average across the country, you're paying 65% more for gasoline than you were paying 4 years ago. Now, if you think about it, your biggest expense besides gas is food. And food is about 40 to 50 to 60% higher on an average throughout the country. So how are we going to survive when you can't make a living and you can't make enough to cover your bills?
In light of these developments, the ongoing economic instability underscores the delicate balance the Federal Reserve must maintain in its policy decisions. The recent market fluctuations and rising unemployment highlight the challenges of sustaining growth without fueling panic or exacerbating underlying economic weaknesses. As we navigate these uncertain times, the question remains: how can policymakers strike the right balance between stabilizing the economy and preserving the integrity of free market capitalism? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.